And I just did this presentation last week at the KRAB conference there in San Diego. It was a really, if you haven't been to a KRAB or NARAB conference, one of the better conferences. It was good to see people again. Now we've kind of got used to webinar world, which is cool. Obviously, we got to make do, but it's nothing like seeing people in person. And for Infinity Investments, we typically have done pre-pandemic, we will do a monthly seminar where we get together physically and we talk business. Looking forward to being able to do that again, hopefully starting in the next part of 2020, the early part of 2022, excuse me, and we'll get rolling with that. So as a couple more people are coming in, we'll go ahead and begin the presentation. This is being recorded and it will be uploaded to YouTube, probably if not today, tomorrow. So group investing and opportunity zones. One second. My name is Steve Peterson, and I'm the broker owner of Infinity Investments. Infinity Investments is a commercial real estate brokerage firm established in November 2009, right in the middle of the storm, so to speak, of the Great Recession. And it's actually a great time to start a business. I also was the past president. I am the past president of the California Association of Real Estate Brokers, that's KRAB. I served as president in 2017 and 2018. In 2018 was a crazy year. I was also the president of NorCal CCIM. And if you don't know what CCIM stands for, it's a commercial real estate designation that stands for Certified Commercial Investment Member. And also it's a networking organization. I served as president of NorCal CCIM in 2018. Also was the president of the Associated Real Property Brokers, which is the Oakland chapter of NARAB in 2015 and 16. And if you don't know what NARAB is, that's the National Association of Real Estate Brokers. That's the Black Brokerage Association. We were formed in 1947 as a way and means for Blacks to be able to conduct business in real estate because we were not allowed to be realtors. So we didn't have access to the database of properties that was available. So NARAB was formed in 1947, and we stand today for democracy in housing. So that doesn't change, and that's a great group of people. If you haven't networked with a NARAB member, NARAB members are called realtists as opposed to realtors. If you haven't networked with the realtists or realtist group, you're missing out. You gotta check that. You gotta check that out. So we are Infinity Investments. We're a brokerage firm. We also put together syndications and investors. We put investors together to go out and buy properties. And so that's what we'll be talking today about is group investing. And it's something that is in commercial real estate is commonplace. And for the small to medium-sized investor, it's a great way to begin extending outside of yourself, doing more than what you can do by yourself. So what exactly is group investing? Essentially, it's when two or more investors get together to acquire property. They effectively are a group now that owns the property. The structure, however, can take many different forms. All right. And when I'm talking about structure, I'm talking about the legal entity, how you hold title, the legal operation, the legal agreements of how you're going to operate the property. What I'm talking about in terms of structure. Very different way. There's a million different ways of doing this. Some not so good and some better than others. You make sure if you're going to say, hey, I'm going to invest in a group, I'm going to put the group together, you want to talk to an attorney, either way it goes, if you're the person putting it together or if you're the person investing, talk to an attorney to make sure the group structure is right for your situation. So a couple of the structures are joint tenancy, not a good way to hold title. Now there is ways to joint venture with people and hold title in a different method of joint tenancy. Joint tenancy is not a good way to hold title. So it's not a great way from a tax standpoint. And really in terms of legacy, if one of the partners passes away, their interest is not able to be passed along to their heirs. It kind of goes back to the other joint tenants. So not a good way. However, people still do it. Tenants in common. Tenants in common was a very popular method of holding title to property as a group, especially prior to the Great Recession. This was the premier way of owning properties as a group, especially for large syndicators, because a lot of people were doing 1031 exchanges. The good thing about a tenants in common structure is that people who are doing 1031 exchanges, they can exchange into a group that is has a TIC structure because they get a what's called a deeded interest into the property. And that's what tenants in commons mean. So let's say you and three other people want to buy a property together. Each one of you has a percentage of the deed. Not, you can also back that up with an LLC, but the difference between simply owning a property in an LLC and having it be tenants in common is you get a percentage of that deed. So if it's you and three other people, everything's equal, you each get a 25% stake of that deed, and that would qualify you for your 1031 exchanges. Some of the negative things about it is, when it's time to sell, or when, like for instance, in the Great Recession happened, when there was foreclosures, it just got very sticky, got very messy. And nowadays, Delaware statutory trusts, DSTs, are kind of more commonplace than tenants in common. But another great way of holding title. Also, general and limited partnerships. General partnerships, not really ideal way of holding real estate. Limited partnerships were big in the 80s and 90s. LLCs kind of took over their place in the late 90s, 2000s till now. I will say this, I have a few of my clients that are going back to LPs, limited partnerships. So that is becoming more popular. And essentially the difference between a general partnership is where the general partners are both liable for everything. So you're not only risking the money that you invest, you're not only risking taking on mortgage liability, but any other risks that come along with the property, everyone who's a general partner is going to be fully liable for that. So the reason why limited partnerships are a much better way is that the sponsor, the people putting together the group, will typically be the general. They will take on the capital risk, they will take on the mortgage risk, they will take on the other operational risks. Obviously, through the entity, going to have insurance, but there's risk there. When there's a limited partner, their risk is only limited to, that's why they call it limited, to the capital that they invest. Now that's at risk, but they're not taking on mortgage risk. They're not taking on operational risk. So that's why a lot of people like limited partners. However, limited liability company, LLCs, offers the passive investor the same opportunities of limiting the liability and maybe a little bit simpler. So I think LLCs are a lot more popular than limited partnerships because it's really a simpler method of owning real estate. It's very popular these days. So that's why, because it limits your liability for even the managing members. And it's, from my experience, and you guys talk to your tax accountant if you're putting this together or investing in something like this, it's a much easier flow through on your taxes. So it's just easier for the accountants to figure out your taxes. Not that much of a difference though between LPs and LLCs. Now, real estate investment trusts, these are for the bigger deals. These are when you have a lot of investors, and most of the publicly traded real estate investment firms are real estate investment trusts. And they are designed to take on hundreds of investors. They have to pay out quarterly dividends or quarterly cash flow. It's a great way if you're doing major deals, which some of us may or may not do. This is a great way to do it. Also, if you're an investor and you're sitting there and saying, "Hey, I just want to invest in some big commercial real estate," you can go in the stock market and invest in real estate investment trusts. I bought some stocks in Avalon Bay, not a lot, but just Avalon Bay is an apartment REIT. They buy apartment buildings, buy and develop apartment buildings all across the country. So they've been around forever. They're an established company. There's companies like that you can invest in if you so chose. If you're going to put something like that together, you really have to be ambitious and looking to shoot for the stars in order to do and buy big deals, because there's a lot of red tape that comes along with that. Some other forms are community land trusts. Community land trusts are really more for the public entities and maybe public-private partnerships. Also a lot of red tape, a lot of restrictions in regards to that. But for nonprofits and maybe public entities, these have been a great way to maintain properties for what their use is, maintain properties for the community, and just another method of buying properties as a group. Opportunity zone funds is what we're going to talk about more in this presentation. And I'll go into depth about those later. But that's a newer structure that came along as of the 2017 Tax Cuts Act, and that allows for people who have sold anything and made a significant capital gain to invest their funds into an opportunity zone fund and defer the capital gains for a period of time. So these are just some of the structures I talked about Delaware statutory trust when I mentioned tenants in common, as that's very similar to tenants in common, a little bit easier to deal with, a little bit easier when it's time to sell. So that's why a lot of the big syndicators now are structuring deals as DSTs. Also, people can exchange into DSTs, and I think that's what makes them very, very popular. A big part of investors who are investing in groups are people doing 1031 exchanges. They've got to reinvest in order to defer the capital gains, and the capital gains, even if you're not in California, is at least 21% and more than that. If you're in California, you're looking at like a minimum of 30% plus. So really understanding the structure, understanding where investors who are doing 1031 exchanges want to put their money will help you if you're looking to put together groups to invest, or if you're looking to invest in a group. Now, why invest with a group when you can go maybe buy properties on your own? Well, you can be able to buy more property than you can purchase by yourself. You can also limit your liability to only the capital that you invest, eliminating mortgage risk and property operational risk. You know, when you buy property, you got to go out and get that mortgage. That's a risk. When you're operating the property, there's operational risk. And there's also the time and management hassle. That's the next one. When you invest in a group as an investor into that group passively, you eliminate the management hassle and responsibility. Now, if you're putting that group together, even if you hire a property manager, which you should do, you still have to manage the asset. You still got to manage the group. There's a managerial piece to that as the sponsor, for sure. That's really a big part of your value in the deal. But if you're investing passively into the group, big reason that you might want to do that is that you are now eliminating the time, effort, and sometimes frustration of managing properties, right? And you don't have that responsibility as well. Now, another reason is that you can leverage the strengths of the members of the group. And this is, I think, a really important team concept. I coach football, youth football, but in coaching football, or really any sport or anything, you're looking for each player to figure out what their strengths and weaknesses are, and you want to play to their strengths, right? And so when you're putting together a group or you're investing into a group, whether it's a small 2 or 3 people or it's a big enterprise, it's a team, right? And so when you're building a team or you're a part of the team, a great way to have success is to figure out what everyone's strengths are and play to those strengths, right? Minimize your weaknesses, play to the strengths. So if you have a strength, maybe 4 of you guys come together, maybe you're really good at finding properties. Maybe someone else has amazing credit, so they can go out and finance properties. Maybe some person who's got a bunch of money, they have bad credit, they don't know what to do with the money. And then another person, maybe they're a good property manager, or they have construction experience. You guys can come together and form a group and get a lot done because you've got people with strengths in different areas, right? And that's how you can leverage that. And then finally, I think the real benefit in investing in a group, if you're doing it right, is that you can truly generate passive income. Without you having to roll your sleeves up, get out there and slay the beast, so to speak, you can make passive income through the group. And that is the attraction for many people to want to invest like this. Now, I'm always going to give you both sides of the story. We talked about the pros, the reasons why you might want to invest in a group. Here's some of the cons. Maybe some of the reasons where maybe you wouldn't want to do it, or just understanding if you do make that move, these are some of the challenges. All right, first of all, investing in a group is very illiquid, meaning that once you invest in that money, that's going to be tight. It's going to be tough to get that money out until you exit the group, as you know, which typically is going to be a sale of the property. It could also be a refinancing of the property, but typically a sale or a refinancing of even if it's a short-term deal, to say you're buying a property and you guys are going to flip it or whatever, or renovate it, rent it out 2-3 years later, sell it. So that's a shorter term. During that period of time, those funds are locked up. Now, just like real estate, of when you go buy it yourself, is also illiquid. The difference is, in order in order for us to tap into our equity, we've got to sell or refinance. You can also potentially sell your interest to another investor, but that's difficult to do. That's why I say it's illiquid in nature. Now, that's the same concept if you own properties by yourself. So real estate owned by yourself, real estate owned by the group, has the same element of being illiquid. However, when it is in a group, you don't control everything. You got a group to deal with, right? This is selling is typically a group decision. Now you can influence that group. You know, that's what a lot of investors do, positive or negatively. You can influence that group when it's time to buy and sell, but you don't control it expressly. You don't have that full autonomy. Even if you're the sponsor putting this together, depending on your structure, right? You may need to get the buy-in, the votes of other members, limited members or managing members in that group. All right. So that's just, you got to understand that going in. Also, the transfer of individual ownership can be very complicated. So you and 3 other people go in a group. Let's say you have 25% of it. Say you have a family event happen, job loss, job transfer, whatever. Now you need to get out of the deal. But the deal's going good, and the rest of the group is like, hey, I understand you came across this, tough situation in your life, circumstances, but we want to continue in this deal because it's working out. And now you need to get your money back. Well, you can always sell your interest in that property to someone else. Here's the problem, is there's not really a defined market for that. So in other words, you can't just throw that on MLS. Now, I've seen people do that. I've seen people sell, hey, we're selling a 25% interest in a property over here. But people not on the MLS, people not on LoopNet, people not on CoStar necessarily looking for that. There are popping up more, I see more and more like crowdfunding sites that may, sell that off for you, but there's not a defined market for it. You got to go out there and yourself find an investor that wants to invest in your, group and take your spot. That price point can all be negotiated. You don't want to lose money, but if you need the money, you might have to, say you put up 100 grand, you might have to, accept somebody's 80,000 just to get the money quick. So what I'm saying to you is that's a very difficult thing to do. All right, it's possible, but it's difficult. Also, you can lose complete control of operations. Let's say you are used to owning your own properties, running your own properties. I have a client, very successful. He owns over 1,000 apartment units here in the Bay Area, and he does not take on any partners at all. And his reasoning for that is he wants absolute control of the building, the way it runs, the way it's financed, when to buy and sell. So he only does things by himself. Now he's got the cash to be able to do that, right? Sold a lot of buildings in 07, came out with several $1 million. So when the market crashed back in 08, 09, he was able to come in and have a fields day. So, it took him time to establish that, but he's at the point where he only does his own thing. So I'm just bringing this up to you because there are cons to investing as a group. All right. You also are dealing with people, and y'all know how people are. So that's the best and the worst part of real estate is the people, right? The best part of business, you get to deal with people, interact with people, have a great time, really make an impact on people's life. One of the more challenging parts of real estate is you have to interact with people, deal with people, and so there's challenges that come along with that. And my advice to you guys is all, whether you're putting a group together, whether you're investing into a group, life is too short to deal with people you don't like and you don't trust. So just dealing with partners can be difficult. Make sure you pick out who you're going to do business with, and have some sort of respect, trust level for them, and ability to deal with them. So every time when they call you or you call them, it's not like pulling teeth having to talk to this person, all right? And also, like we kind of brushed on this, but the decisions on when to buy, sell, refi, all of that is a group decision. So it's not yours on your own. Now, as a side note, if anybody's ever volunteered, like I was mentioning, the Realtors organization, I mentioned CCIM. Those are two great trade associations that I'm a part of. I'm sure there's a million others in real estate. I think what's helped me out a lot is volunteering and on leadership and eventually getting up to be the president, because you get used to dealing with groups when you're running a board. That was different from me running my brokerage, where I'm kind of making all the decisions, good or bad. It falls on me. When you're in a board setting, you get used to dealing with, you know, volunteers that have an opinion, and that's a great training if you're not used to that already, of how to deal with, a group that you're investing with. So if you're starting out and you're saying, well, how do we, develop a understanding of this? Volunteer, develop some leadership skills, because if you're going to put a group together, or even if you invest passively in the group, having leadership prowess, executive prowess, allows you to have a positive influence over what's going on, even if you don't have all the power. You know how to deal with people. You know how to, you know, get what you want and persuade in a positive way. Leadership skills help out, and that's certainly the case, I think, in group investing. So let's break it down a little bit more technical. So group investing, essentially what we're talking about is syndication. Now, there's different levels of it. If you and a couple buddies just buy a property, not really a syndication, but it is, because group investing is often referred to as syndication. The words group investing and syndications are often interchanged for each other. A syndicate may be defined as a group of people who form an association to undertake a business transaction. So, and essentially, if you two or three people, form a group, you are a syndicate. Most of us in the business look at a syndication as something where a sponsor is going to come together and they're going to go out and raise a significant amount of money. Right? However, even if it's just you, two, three people, essentially it is a syndicate. So, and I want to reference a book. It's called "It's a Whole New Business" by Gene Trowbridge. Gene Trowbridge is also CCIM. He's an attorney, and he's the country's really leading expert in the area of real estate syndications. So if this is something that, again, you're interested in, either putting it together or investing, I would suggest go on Amazon, cop his book, It's a Whole New Business. There's a couple updated versions available, so I certainly would go out there and get that if you're interested in this seriously. Now, here's just an example. Say you want to buy a 20-unit apartment building that costs $2 million. You don't personally have the resources to do so. So you form a syndicate of 10 investors who contribute $200,000 each to acquire the property. Now, that's in seminar world. That rarely is going to happen that way. Typically, say it's a 20 unit for $2 million. You're going to go out and get a loan for 50 to 60% loan of value. You're going to have a down payment of $1 million or 800,000. Then you're going to go out and raise 800,000 from investors. Now you have to set, when you're doing this, you have to set minimum increments. So your minimum increments can be 50,000, it could be 100,000. These are called the investment units. So there's got to be some sort of minimum increments. It could be kind of whatever you define. Again, talk to your attorney. You need an attorney doing this stuff. But it's now, when you put this together, whether it's 20 people putting up 100 grand, or 10 people to put up 200 grand, or 5 people putting up different amounts, which is usually how it is, by the way. Rarely have I seen it to where there's 5 people and everybody puts an equal amount up. It's usually one person puts up more, one person puts up less, whatever it is. That's an example of a syndicated property, a group investment, right? Now, those are just some of the logistics of what it is, why you should do it, what are the challenges. Now, here's where the rubber meets the road, especially if you're putting this together, right? Or there's people out there looking to invest in this stuff these days. Raising money is where the rubber meets the road. And there has been some rule changes. The Jobs Act of 2012 created avenues to advertise investment opportunities for small businesses and start to put this together, how you can find and how find investors and develop webinars like this. Now I know webinaring, it's a lot harder to, being in a webinar is a lot harder to, network than at a seminar. So I know during this pandemic era, you guys, it's a lot harder to network online. It can be done though. I've gone to several different meetings where there's actual dedicated time. Also, so when you're raising money, you got this business and did some deals really when I, was just getting going. And what my moral authority or my value to the group or my value to the okay, sorry about that, guys. We got knocked off. I truly apologize about that. I don't know what happened there. I'm gonna go back to the screen share. Glad that you guys didn't get knocked off. All right, give me a, all right. So we're back to where we were. Sorry about that. Anybody that, technical difficulties with this webinar, I can't wait to get back in the seminars, seminar world. So I truly apologize about that. We'll kind of get right back where we were talking about raising money. So you got to develop relationships with people. Having pre-existing business acquaintances is going to help out. Past clients, referrals, right? From clients, attorneys, accountants. And I bring this up because when I was getting going into business, well, I did a lot of business through like accountants. Accountants are really good people to know. Now, especially for the brokers and agents, and I know looking at the participants, there's a few of y'all that I know are agents in the business. You want to have some CPAs that even if you're selling real estate and that's all you're doing, because a lot of CPAs, their clients have issues where tax issues, where buying property or investing into a group, doing a 1031 exchange, doing an opportunity zone can help out. So you certainly want to have the relationships with accountants, financial planners, wealth managers, right? These are people that you want them to know that you are in business, and particularly when it comes to group investing. So if you have a CPA, man, hey, Mr. CPA, you know me from, I'm a client. Hey, I'm going to be raising money for properties out there. If you know anyone who could, could benefit from investing in a group, let me know. Give them my phone number, so on and so forth. You want to develop those relationships. And another source is existing property owners, because existing property owners, especially people who are getting up there towards retirement, a group may serve them very well. They could sell this property, one of the properties they have, exchange, and invest with you. So these are great, great opportunities. Now, in today's world, crowdfunding, like I mentioned before, can be an option for you to raise money for your group, for your syndication. However, let me just say, you need an attorney when you do this to put together the proper documents, and it can be very expensive and arduous. But if this is something you're serious about doing, it can absolutely be worth it. All right. So these are just some of the ways of raising money. Raising money is an art form. Again, get as much education you can on this topic if you're going to dive into it, and then go after it. Now, who are some of the individuals that would be ideal prospects for syndications? Well, these would be individuals who have self-directed IRAs. These are IRAs where people went and self-directed it. They went to a company like Pensco or Intrust used to be out there. That those are companies that handled self-directed IRAs, where someone says, "Hey, Schwab, I need you to send me $100,000. That's going to go to Pensco. Now I'm going to set up my own self-directed IRA so that I can choose on where I want to invest." Those folks can invest in real estate deals. They can buy real estate outright, buy other investments, and they're great prospects because these are really long-term minded individuals, because their investment is in that IRA and they can't really touch it until they're a certain age. If they do, there's a penalty. So any yield that they make from the project goes right back into the IRA. These are great prospects for you. Also, people who are doing 1031 exchanges, obviously they need to put their money somewhere in order to defer their taxes. Big part of why they're doing the exchange is they're looking for an investment vehicle that would allow them to defer taxes. Now, in my talks and webinars and videos, I'm always talking about, if you're doing an exchange, you need to be finding a better asset, not just deferring taxes. But these can be great prospects for you if you're putting together a group. And if you are in that situation, you can invest in groups, DSTs, individuals that you know, in order to satisfy your exchange. Also, another thing to think about, busy professionals who have capital to invest, but they don't have the time to find real estate, to manage real estate, to be involved in that aspect of it. They're just saying, hey, I got cash, I like real estate, who can I invest with, that I can make sure I get a yield from that. So those are great prospects. Also, ambitious investors seeking to invest in projects larger than what they can buy on their own. So, a lot of times people think with this whole group investing thing is that you've got to just find, people who only want to put up money and be passive investors. Well, you might be an ambitious investor. You might partner with another ambitious investor. Now you guys can do a bigger deal. All right. So those are just some ideas. Also, people who have realized the capital gain. Say someone who sold their company, someone who sold their stocks, someone who sold a Michael Jordan a rookie card and made a ton of money and is looking to defer taxes. Those can be people that can invest into opportunity zone funds and defer taxes, something that I'm getting ready to talk about. Now, we talked about what group investing is, laid the foundation, the pros, the cons, why you would do it, the structures. We talked about, hey, you got to go out and raise capital. How do you go out and raise capital? Who do you talk to? What are the prospects? Now we want to talk about a specific topic called opportunity zones. And the follow-up to that is opportunity zone funds. A lot of misconceptions about this, right? Especially in the broker agent world. A lot of us in the broker agent world are marketing properties that are located in the opportunity zones as if someone can just buy that property and defer taxes. There's a few things you need to know. All right, first of all, the qualified opportunity zone is an opportunity zone is a designation created by the Tax Cuts and Jobs Act of 2017, allowing for certain investments in lower income areas that have tax advantages. The purpose of this program is to put capital to work that would otherwise be locked up due to the asset holder's unwillingness to trigger a capital gains tax. Opportunity zones are census tracts generally composed of economically distressed communities that qualify for the opportunity zone designation, according to the criteria outlined in 2017's Tax Cuts and Jobs Act. Now, how they came up with this, there's a map. Everywhere in the country has a map of the opportunity zones. All right. How exactly they came up with that, I don't know, because there's parts of East Oakland where I'm at. One side of the street's the opportunity zone. The other side of the street is not an opportunity zone. That other side of the street is still economically distressed. So I don't exactly know how they did that, but know that there are existing opportunity zones plotted and mapped out in a town near you or in where you are across the country. All right. That's just the zone, the location. Now, the mechanism that allows someone to invest and defer their capital gains tax is the opportunity zone fund. It's the entity that has to be structured to receive the capital and then to deploy the capital into the specific deal, property, business that is located in the opportunity zone. So understand, the zone is the location. The fund is the entity that corrals the capital that invests in a specific project that must be in the opportunity zone, that must be located in the opportunity zone. Okay, so here I'll explain, what the opportunity zone fund is. To access these tax benefits, investors must invest in opportunity zones, specifically through opportunity funds. A qualified opportunity fund is a U.S. partnership or corporation that intends to invest at least 90% of its holdings in one or more qualified opportunity zones. Because opportunity zones are intended to stimulate positive growth within designated communities, there are restrictions on the types of investments in which an opportunity fund can invest. These investments are called qualified opportunity zone property, which is defined as any of the following. Now, note, the qualified opportunity zone property does not have to be only real estate. All right, it can be, number one, partnership interest in businesses that operate in a qualified opportunity zone. It can be an investment into a business. Number two, stock ownership in businesses that conduct most or all of their operations within a qualified opportunity zone. And lastly, property such as real estate located within a qualified opportunity zone. So these are the investments that the fund can invest into in order to defer capital gains for the investors. Okay, those properties, projects, deals have to be located within the opportunity zone, the area designated within that given city, state, county, wherever you are. All right. Now, here's the structure of how it kind of maps all out. The fund is a parent entity that then can invest its capital into the holding entity. So the fund is the parent up here. The holding entity is the entity that owns or controls the property, business, or operation. And I will say that entity owning, it can own the property outright or the business outright, or you can control it via a long-term ground lease. You can control it via an option to purchase, something, land contract deed, an element, contractual element that gives the holding entity control over that site. It does not have to be outright ownership in that deed. A ground lease will do just fine as a method of controlling that property. Now it's all, again, you want to have lawyers involved doing this, and you want to make sure things are, we're starting to get sophisticated here. So you want to have a team that you're working with on this. All right. Well, understand that when you set this up or you're investing this, you're investing into the fund. The fund's just the holding, the parent that holds the dough, then is going to invest into the holding entity, which is the actual entity that owns or controls the property or business or operation that you're investing in. All right. So the investor essentially is investing into a group. That group is the fund that then invests into a qualified activity. And in doing so, they can defer the capital gains. Right? And they can do so in a way that's not as restrictive as some of the 1031 exchange rules. Like, for instance, when you sell a property in your exchange, and you got 45 days from the close of escrow date to identify your up-leg property, your replacement properties. 180 days from the close of escrow to close on that property. On the face of it, doesn't sound that stringent until you get into it. And then those days can be very pressure-packed. From an opportunity zone, you got 18 months from the time you realize that gain to make a move. And you also can hold those funds in your corporate account. All right. Now, here's a caveat. The California Franchise Tax Board does not recognize the opportunity zone deferral. And therefore, if you realize a gain in California, you still have to pay California capital gains. All right. So I just want to mention that out there. So we are in the Golden State. That being said, let's say you sold a property in California. At a minimum, you're paying 21% Fed. At minimum, I think you're paying 9.5% California. So you're already at 37% right there. If you defer the Fed capital gains, you're still deferring 21%. But if you made $1 million gain, if you didn't have a way of deferring that, you'd be paying at least 300 something grand in taxes. In this way, if you did an opportunity zone investment, you can defer at least 21% the Fed capital gains, and you're only having to pay with the state of California. Everybody else, all the other states, well, I don't know. I think there might be a couple other states that don't recognize it as well. Our state, of course, loves the tax people, so they do not recognize it. Just wanted to make sure I reiterated that. Now, another thing to consider, I was just actually talking to someone about this yesterday, is that when you're doing this, say you want to go and you want to set up a fund, you sold a business or property, you want to reinvest it, you want to do this. Also, you have to invest a significant amount into the redevelopment or development or the improvements of the property. There's a allocation formula for this. And this is when you lean on your accounting team to put this together. But what I can tell you, my understanding, it has to be a significant amount put into that property. And the way it's been explained to me that I understand it is whatever the improvement value allocation of that property is, you need to invest at least that. So every property is going to have on its tax bill, is going to have an allocation for land to improvements. And that improvement amount, whatever that allocation is, every property is a little bit different. Whatever the allocation of land is in the value and the improvements are, that amount, the improvement value is what you got to reinvest into the property. Now, there's actually a more defined formula, and you need to talk to a CPA about this, but that's the simple way that I understand it. And typically, that's going to be more than 50% of the purchase price. Now, it may not be, depending on what you're buying, but understand, this is not something that you do simply for you to acquire a nice, renovated, fully occupied building that is just, cash flow. There needs to be a significant amount of capital reinvested into the project to bring it back into life in order for it to qualify for the tax deferral. All right. A lot of people are missing that. A lot of people are missing the fact that you have to structure a fund in order to do this. You can't not simply just buy a property that's located in the opportunity zone and defer your taxes. Okay. And now also, here's another thing. We're talking about groups. Most of the structure of this is as a group. You can do this on your own as well. I don't know how much of a benefit it would be to only do it by yourself, unless you got huge capital gains. But this can be done by yourself. It's a lot of maneuvering around to do that. But maybe, and if you're selling a property, maybe you just do an exchange. But if you sold your business, if you sold some stock, or you sold some precious metals or art, or like I said, a Jordan rookie card or something like that, you're going to need somewhere you're going to need a method or mechanism, or be wise to defer those capital gains by investing in something like that. And I hope that helps. Hope that makes some sense. Now, like we did with the whole topic of group investing, there's pros and there's cons, right? When I do my presentations, I always like to address this, because I just think that if you look at both sides of the coin, the positive and the negative, I'm a positive, optimistic person. That's just who I am. But I've learned through the business, and I've been in this business, commercial real estate, since 2003. I've learned you have to also analyze, understand all the risks and all the negatives, the cons, that for each deal, for each market, for everything that it is that you're doing. So within an opportunity zone, some of the pros are that you have up to 18 months to make the investment, right? In 1031 exchanges, you got 45 days to identify what you're making investment in. 180 days to close it, but that 45 day, that's a tight window, right? Another pro is that you can hold your capital gains in your business account. When you're doing an exchange, that money goes into the exchange accommodator's account. All right, so at least that money is in your account. If stuff hits the fan and you got to make a move and say, screw this opportunity zone thing, that money's in your account. That money's in the exchange account. Let's say your exchange is blown, it's going to stay there, my understanding, for 180 days. Once the 180 days is up, they can return your money. Meanwhile, you may have been trying to exchange into something, missed your 45 days, and then day 100, you found a great deal. You can't exchange it to it because you missed your 45 days, but you found a great deal. You got the money for it. You can't hop on it though, because your money's locked up into that 100. The exchange intermediary can't give it back to you until that 180 day period is up. All right, that's one of the pros for an opportunity zone. is that investment? Is that now it's in your bank account? Hey, sometimes it's okay to pay taxes if you find a better deal. Let me just say that. A lot of times people want to just defer taxes and do a not so great deal. You'd be better off paying the taxes and putting that money into a better deal. If you can defer the taxes and get the better deal, that's what we're trying to do. All right. Now, when you invest into an opportunity zone, if you hold that project for 10 years or more, once you hit the 10-year mark of holding it, the new capital gains, so you sold your company, you invested money into an opportunity zone fund, you bought a new property. Let's say you bought that new property, you hold that property for 10 years. Now, if you bought right, especially here in the state of California, that property value is going to be much higher than it was when you bought it, right? A lot of times here, it's going to be double or triple. So the new capital gains, that's the new growth, you are not paying capital gains taxes on that new. And I think that is significant right there. That's just really, now that's when you start thinking long-term, that's when you start thinking having a wealth mindset that you can really benefit by something like that. And 10 years sounds like a long time, but it goes by fast. You know, my son just turned 10 this year and I couldn't believe it. I just was like, whoa, that was 10 years? Yeah, it was. So if you're in a deal, if you're thinking, when you're doing this stuff, guys, even if you're flipping property, you got to have a long-term plan. So you shouldn't just be flipping property to make money. If you flip a property to say, hey, I'm going to make this money so that we can go and buy and invest in a bigger deal or better flip deals or whatever it is that you're doing. But we got to start having a long-term game plan. And when you're doing opportunity zone funds, it requires that. Now, some of the cons. Now, this is the biggest con, and I do not understand all the details around this. I'm not even going to pretend to understand. But there's an event that happens in 2026. Now, I don't know what it was the Trump administration thought about 2026, but at 2026, the investors who invest in a fund need to pay their realized capital gains taxes. I don't know why they came up with that. I don't know how they came up with that. That doesn't make any sense at all. But that is the existing rule. And so, what this allows you to do is upfront not pay your capital gains taxes and reinvest that into something that's going to grow. However, in 2026, you need to be prepared to pay those taxes. So a way to do that may be to invest into a project that's going to return you capital, enough capital that you can stack up money and pay your taxes at that time. You may want to invest that capital and keep some money of your own in reserve so that when 2026 comes around, you have money to pay the capital gains taxes. But that's a huge con in this whole thing, all right? A lot of people, especially people who are making bigger money, bigger capital gains, still see the reason, still see the value in doing this because you can reinvest the whole amount. And if you make some wise investments, like I said, with the money that's yielding off of that, you can pay your capital gains. But bottom line, that's a big con right there. Absolutely, probably the biggest con of the whole opportunity zone structure. Also, you're investing into a pool group, you're investing into a fund, so you don't have all the control like you would if you individually bought a property. But that's the same con as investing in the group, all right? Now, another thing to think about is there's several unknowns about this. This is a newer thing. It is subject to tax law. Subject to changes in the tax law. Now, we know that the Biden administration most likely is going to increase taxes. How that gets administered, it can be administered in many different ways. There are even discussions about ending 1031 exchanges, although I think when they sit down and analyze it, 1031 exchanges bring more value to the table, than it does, bring more, tax revenue to the government, especially because if you take away the 1031 exemption, a lot of those people who would sell are not going to sell. So I don't think they're going to take away the 1031 exemption. And from what I'm hearing, talking to my CPA, they think the Biden administration actually likes the opportunity zone. What they want to make sure people are using it the right way. In other words, they're actually improving the neighborhoods they're investing in, not just making money. But as it looks right now, this is going, at least in this next administration, is going to continue. but it's subject to change. And tax law changes historically in this country have had a major impact on the real estate market, stock market, business environment. I'll give you an example: the 1986 Tax Act, Tax Reform Act, dramatically changed real estate because from 1981 to 1986, you can invest in real estate and lose money and write all of that off. And that got changed in 1986. So you had from 81 to 86 people not wisely buying properties for the purpose of losing money. And I say that's not wise because if a law gets changed like it did, all of a sudden, all the losses and these were people who needed write-offs. So syndications really boomed in the 80s, but then changed when 1986 happened. So a lot of people lost properties. A lot of properties went back to the banks. Savings and loans had a lot of loans out, and there was what they call the saving and loan meltdown or debacle. So tax laws can change. Now, the government looking at what happened in 1986, nobody really wants to kill the economy on their watch, so to speak, right? So that's why I think Biden administration is really taking some time, no matter what side of the aisle, the fence you're on. They're going to, bottom line is there's going to be some new taxes or increases in the taxes. I just hope that they are diligent about this in doing it so that they don't kill the economy. I think they are because they don't want that to happen on their watch. Nobody does. But understand when we talk about opportunity zone funds, it is subject to tax law change. So I wanted to keep it real with you, both the positives, the negatives, the pros, the cons, the structures. And now I'll give you a little bit of an example as we're moving towards wrapping this thing up. All right. Let's just say, for instance, you sold a fourplex, and this is an example, kind of comparing it against the 1031. Say you sold a fourplex and you realized the $500,000 gain. Now that fourplex is in Oakland, so you got to pay Uncle Gavin his California taxes. So you pay 9.5% of that gain at close, or that year, that tax year, $47,500. So now you got $452,500 to invest, and you invest that in an opportunity zone fund. And that fund, let's say, is paying out 4% annual. So it's paying out 4%. So you're making $18,000 a year. Now in 2026, if you invest, you may have to pay the capital gains taxes, 21%. Now, if you did that, that would, we calculate would be 105 that you need to pay. All right, you can now pay that a good portion with that. You can pay a good portion at 105 with the 4% yield that you are making every year. That's why a lot of investors still invest in these things, and that's why there's so much capital has been raised. Because people are saying, hey, I can put all of my money in work and start getting the interest on all of my money. And when it comes time to pay those gains, I can pay it. And a lot of times people who are investing like this, they got a lot of it, right? That's why they're so interested in deferring the capital gains. If this is your one and only property that you sell in, and you're running tight on everything else, you might need to set aside some money instead of investing that whole 452. You might want to invest 425, have some money set aside, and then with the money you bring in from the yield, stack that up and prepare to invest or to prepare to pay your capital gains in 2026. Well, let's just say, in this example, a good chunk of it you paid with the annual yield that you brought in from the fund. Now you hold the property for 11 years. Your equity doubles in value, and now you pay no capital gains. So let's kind of break that down as a summary. You paid 152 in capital gains total. 108,600 you paid from your yield. All right, so a big part of that you paid from the money you earned the first few years, and you had to pay the California up front. However, now the 452.5 investment doubled in value. So we said that grew to 904. Now that 904, that difference between 904 and 452 is now a new capital gain. That's now tax free. And once you pay that gain in 2026, the yield that you made from that is all gravy. It's all coming to you. And that was in this example, 90,500. So this is the power of investing into an opportunity zone fund. even with the negative piece of having to pay capital gains taxes. And that's why you would do something like that. Now, to compare it with a 1031. Now, let me just say this. Y'all know, especially if you follow me, you're watching any of my videos, you know how big of a deal 1031 exchanges are. I've been doing them since I got into the business in '03. I'm doing several of them now. I do a lot of videos, talks, contents about them. This morning I was, we're closing a deal that's an up leg for an exchange. So we were tweaking numbers. We had to lower the loan amount this morning on a deal I'm working on just to make the exchange totally tax deferred, which is great. Lowering the loan amount, by the way, is a lot easier than raising the loan amount, just if you ever have to do that. So at the closing table. So we were able to do that. But look, you know I love 1031s. I just want to say, hey, this can be an alternative. Now, if you're selling a stock, you can't 1031 it into a building, right? You can potentially, put it in the opportunity zone. But let's say you sold your fourplex. So it's apples to apples. Now we're talking about opportunity zones and 1031 exchanges, like the previous page, right? Difference with the opportunity zone fund, you got 18 months to invest versus 180 days. And there is no 45-day identification period. The biggest problem with 1031s is that 45-day ID period. That's why in my videos, I say, hey, if you're going to do a 1031, you need to start looking for that replacement property as soon as you start selling your download. So as soon as you list that property that you're going to, or as soon as you go into contract on that property that you're selling, you need to be on the hunt looking for the property to buy. All right. Not waiting till it closes and say, oh, I got 45 days. That's not a lot of time to find a quality investment. All right. So there is no 45-day identification in opportunity zone funds. All right. And you don't have to stick to like-kind investments. You can sell your stocks and buy real estate. All right. It just has to go through the fund and has to be structured like we talked about. You do lose absolute control over the investment. And so, but that would be the same thing. Let's say if you 1031 into a DST, be the same idea because it's a group. All right. And you invest into a pool and you don't have a deed. All right. So that's the biggest difference. When you 1031 exchanging, even into a DST, you're going to get a percentage of the deed. You get a percentage of that deed. Right. That helps qualify your investments. You don't get that in the qualified zone, a fund, because you are investing into a fund, LLC most likely. Right. And there's also several complexities and unknowns with opportunity zones. So those are, again, just comparing it side by side. I love 1031s. I really think the opportunity zone funds are for people who are realizing gains from business gains, stock gains, other gains, which, by the way, a lot of people have made a ton of money in business the last few years, right? So if you're making some business money, or maybe you sold a business and you're saying, hey, how do I reinvest that in a tax advantage way? Opportunity zones could be a way to do it. All right. Got a property. I'm not going to go into detail, but I'm excited. We're closing it. It's the old Soul Beat building in Oakland. Soul Beat was basically a cable station in Oakland and was kind of like Oakland's BET. There's a local Black-owned cable station that did a lot of good for the community. Long story short, there's a building. Their building that Soul Beat got shut down, I think in '03. The building went into foreclosure. The guy bought out of foreclosure. Our group is going to be acquiring actually acquired the building next door and closing on the Soul Beat property here in the next couple of days. We are formed an opportunity zone fund, and we're going to be doing what I've been talking about on this site. Very, very excited. Not going to go into the details, but it's something I just wanted to share with y'all that we are doing. It's a way, a method, a means for us to make a positive impact within our community. This is on 73rd Avenue in East Oakland. That's going to bring economic vitality to this area, to this neighborhood. That's going to bring jobs. And it's going to bring positive, just growth to this area, because it checks all the boxes for what we talked about in the terms of the location. We employed a great lawyer, attorney, and CPA to put this stuff together, and it's going to be a significant amount of money has to be reinvested to bring this property up to par. So I'm excited about that, and I hope this, I hope this talk, if anything, springs you into action. I'm a couple minutes over 1 o'clock, but I wanted to talk about some action steps. Whoever's listening to this, there's a few of you here live. This is going to be on YouTube. Bottom line is decide to do something. You logged into this, or you're watching this for a reason. You got a motivation. The biggest thing is to act. So decide if group investing is something that you would like to participate in or something that you would like to arrange or coordinate. You can do both. All right. Link up with people you like and trust. I talked about the Realtors Organization, NARAB. I talked about CCIM. Those are some of my groups. There's also your Chamber of Commerce, there's the Black Chamber of Commerce, Hispanic Chamber of Commerce. There's a million different organizations that you can go out there and network with. You got to link up with some people that you like and trust if you're going to do this. All right. You also got to decide what type of properties that you want to invest and go after and put this in your investment criteria. If you're going to go out and put a group together, if you're going to go out and buy properties like this, my suggestion would be is to develop expertise. Like for instance, my brokerage, my investing life is focused on multifamily properties, multifamily apartment buildings, 5+ and up. We do 2 to 4 units, but our focus, our expertise is 5+ units. Yes, in my brokerage, I've sold office, retail, other types of properties, but our sweet spot, our expertise, what we're known for, multifamily. So get a niche, get something that you're going after, and then consider working with our group. If you're out there, looking to invest or do something, we can sit down and meet and talk, or start your own group, or find somebody else that's out there. But if this is something that that makes some sense to you, take some action steps. I think the biggest thing that I'm saying, as a broker and investor in the world, we do these seminars, webinars, content videos because it's our business model to educate our marketplace, because that's our way of bringing value and then hoping that folks wrap around and do some business with us. But take action. One thing about seminar world, education world, that's a negative is too many folks go to seminars, get great education, but then don't do nothing with it. So if there's one thing I would say, is take some action steps. Whatever that is, take something. All right, just don't do nothing. Do something. Take some action for your family, your community, for your portfolio. Just do something. And if this was of value to you, whether you want to do business with us or whatever, stay tapped in with us. Okay, and a great way to do that is our YouTube station, Infinity Investments on YouTube. You can pull up Steve Peterson, Infinity Investments on YouTube. This is kind of an old, this is from a few months ago, snapshot where it says 791 subscribers. We're up to 1,000, about 1,100, almost 1,200 subscribers now. Not nothing to write home about, but we are growing. But the bottom line, you guys, is that what we do is we provide value on a weekly basis to our network through these videos. And all of our webinars are put on video. All of our content that we do is put on YouTube. So stay tapped in with us. Now, couple minutes. If you got to go, feel free. Couple minutes. I'm going to go into chat, see if we have any questions here. Okay, Mariah says excited to be here. Thank you. Reba asked if this will be, absolutely this will be on YouTube, most assuredly. All right, hold on one second. Okay, Mariah says, that's what I'm interested in, also leasing commercial property for QRZB. Yes, Mariah, we need to talk. Book some time. Let's book some time to get together. Mariah also says, does that include affordable housing, clean tech, or do they not keep their word on that? Affordable, all of those are qualified activities. Affordable housing, clean tech, really the list goes on and on for what the business can be. There's all kind of business. I think there cannot be cannabis business or alcohol business and stuff like that, but the actual business can be a lot of different things, all right? So Mark Porter, great job. Thank you, Mark. We need to talk. We should all share the YouTube link with everyone. Thank you, Mark. I appreciate that. We're trying to put some value out here in the marketplace. I appreciate that, you guys. That's our business model. That's what we do. Been around since 2009. We're growing as a company, but that's what we do, and it's worked out well for us. So I appreciate you guys. I'm gonna stop the share now. Have a great rest of your day. Share this information. If you want to link up with us on our Calendly links on all our videos, go to one of our videos, book a time to talk, and let's do some business. The bottom line, take action. Take action. All right. Don't sit on your hands on this information. Move forward, take some action. Me being a commercial broker, I see opportunity on the horizons coming out of this pandemic, especially for commercial properties that need to be repurposed, that are located in opportunity zones. That's what we're doing. Hope to inspire you to do the same. Be blessed. Have a great rest of your week. Peace out.